Welcome back to MB Capital Strategies. Today we're talking about the topic of shipping. Just imagine the following. The ships that transport 90% of everything you use daily, your phone, gasoline, and your clothes, will suddenly have to pay in full for every single ton of carbon dioxide starting in 2026. Currently, the price of CO2 is about 83 euros per ton, and the serious forecasts for 2026 look like this. Bloomberg NEF predicts 93 to 120 euros. Reuters median, that is, the average value, was 100 euros. And Vertis Environmental Finance even made a peak prediction between 110 and 150 euros for 2026 to 2027. Here are the current figures. We're at 83 euros. Here's an article from Reuters. 92.48 euros for 2026. Of course, I will link all the sources and you can always look up more information at any time. What does this mean in reverse? Freight rates worldwide will rise between 1 and 5%. Old ships will become unprofitable overnight. Modern eco-fleets will earn premium charters, and the industry will be completely turned upside down. We're talking about one of the biggest structural changes since the switch from sails to steamships. And before we start, it's very important. This is not some ESG fairy tale. I don't invest in green promises. I invest in efficiency and cash flow. Today, we'll take a look at who the losers and winners are and why the next decade could be historically profitable for shipping. Why shipping was dirty for decades and at the same time, brilliant. A few quick facts. 90% of global trade is conducted by sea. Shipping is responsible for over 3% of global CO2 emissions. The average age of fleets is between 13 and 16 years. New ships, on the other hand, consume up to 40% less fuel. Shipping was cheap, dirty, but indispensable. And this is exactly where the new regulations come into play. The 4 regulations that change everything. EU, ETS, maritime, full costs. Active since 2024, fully effective from 2026. Fully effective as of January 1st, 2026. Every ton of CO2 emitted must be paid for. Previously, shipping was completely exempt. CO2 costs at 0 euros until 2026. 100% of CO2 emissions will be subject to ETS requirements. This applies to CO2, methane, and nitrous oxide. Here would be the source is EU Directive EU 2023-959, which I also currently have open here. Exactly, you can also currently find it under European Union. You can also read it here as a PDF if you like. Then we have the full EU maritime from 2025 onwards. Fuel EU stipulates how emission intensive a ship's fuel is allowed to be. The targets are for 2025. -2% by 2030, -6%, and by 2050, -80%. And here, the Maritime Regulation EU 2023/1805 comes into effect. Here too, on the official European Union website, you can take a look for yourself if you like. As I said, I have simply highlighted the most important points that concern me regarding my shipping stocks. And at the end, as mentioned, we'll also go through which ones benefit and which ones I have in my portfolio once again. Now we come to the IMO key rating from A to E. CII stands for Carbon Intensity Indicator, meaning the carbon dioxide emissions per ton transported per nautical mile. Here we have rating A, which is very efficient, and E, which is very inefficient. A poor CII means 3 years in D, or 1 year in E. The ship must submit a corrective action plan, charters avoided, costs increase, routes get worse, and cash flow collapses. In short, good CII equals demand, bad CII equals cash burn. What does a corrective action plan really mean in the context of IMO CII? The corrective action plan, CAP, is a mandatory action plan. Shipping companies must create one for each vessel that receives a CII rating of D for 3 consecutive years or a rating of E for 1 year. In effect, it is a retrofit plan, but it covers more than just technology. The cap includes technical measures such as retrofitting, propeller upgrades, hull coating, recoating, energy-saving measures, rotor sails, wind assist, exhaust gas reduction systems, engine derating, and optimized route and engine management. This is the part that falls under retrofitting. Then there are also operational measures. For example, reducing speed, optimizing travel profiles, better loading, and route planning. These have an immediate impact on the CII but cost charterers a lot of money. Monitoring and reporting, obligations. The ship must demonstrate progress annually, showing that it will achieve an A, B, or C rating. And it must document the implementation. Failure means the risk of charter cancellations, port restrictions, classification problems, and insurance issues. So, in short, the ship must specifically demonstrate how it is improving its efficiency. This can happen through actual retrofitting, such as propeller upgrades or hull coatings, or through operational measures like slow steaming. In short, it is a mandatory refurbishment and retrofitting plan for inefficient ships. Number 4. IMO GHG Strategy 2023. Goals: -20 to -30% CO2 intensity by 2030. 5 to 10% zero emission fuels by 2030. Net zero by around 2050. Midterm measures such as a global CO2 price possible by 2027. The source is IMO Strategy 2023. Why exactly this is a brutal supply shock? And now comes the part that will completely turn the industry upside down. Shipyards are as full as they haven't been since 2008. According to Clarkson Shipping Intelligence Network, global shipyard utilization is at 92.3%. China at 94%, Korea at 96%, Japan at 89%. This is the highest utilization since 2008. And now the crucial point. Slots for large ships are fully booked until 2028-2029. The specific figure, VLCC delivery at the end of 2028, beginning of 2029. Suezmax 2028, Aframax LR2 2027 to 2028, product tanker MR LR1 2027, bulk carrier 2028. That means if a shipping company orders a ship tomorrow, it won't be in the water for another 3 to 4 years. And at the same time, new build prices have exploded. VLCC between $135 and $140 million. Suezmax $90 to $95 million and LR2 between $70 and $75 million. That's plus 40% since 2020, and that's the structural supply shock. Old ships are expensive, new ships are not available, demand is stable, and regulations are stricter. That means modern fleets will be the winners of this decade. ETs used to cost less, now they're worse. Realistic and tangible. And now it gets specific. Let's assume we have a VLCC ship going from Rotterdam to Singapore. We have 8,000 nautical miles, consumption of 65 to 70 tons per day. A CO2 emission of 750 to 900 tons. Before ETS, €0 in costs starting from 2026. 58 tons times €100 per ton is €85,000. Around $92,000 extra per voyage. The conservative estimate ranges between 50,000 and 100,000 euros extra per voyage. Every inefficient ship pays annually $300,000 to $500,000 in additional carbon dioxide costs. Efficient fleets save that and at the same time earn premium charters. The 4 real technologies, no dreams. Ammonia, CO2-free when burned. CMB Tech is a leader in this field. First man-wing D-dual fuel engines in 2026 to 2027. 100 ammonia-ready ships are planned. And CMB Tech will buy 9 of them. The delivery of the ships will take place between 2026 and 2029. Before 9 ammonia-powered vessels, LNG and LPG dual fuel, 20 to 25% less CO2, and the infrastructure is already in place. Dorian LPG and Flex LNG are directly at an advantage. Now let's move on to green methanol. Max has ordered a total of 25 ships. And as we can see, one has already arrived on June 18th, 2025, according to the official press release from Max. First vessel equipped with dual fuel methanol. So I would say let's just move on to the winners that I have in my portfolio. Here, my big winners are CMB Tech, formerly Euronav, which has merged with Golden Ocean. It's actually currently one of my largest positions. Entry price at 8.46 with 2,261 euros and 78 cents invested. Then Hafnia with 109 euros invested in total. Then we also have Torm with 1,759 euros and 12 cents invested. And then we have Okeanis here with 200 euros invested. And then we also have Dorian LPG invested with 1,923 euros. Then here we have solid winners. That would be Flex LNG. Here I have invested 2,238 euros. And then we also have BW LPG. And here I have invested 875 euros. Then neutral to slightly positive. That would be Frontline. Here I have invested 460 euros. And International Seaways. Here I have invested 685 euros. The losers include, among others, Diana Shipping. They still have some catching up to do or need to invest quite a bit more. Then we also have Genco Shipping and Trading and Star Bulk Carriers. Here I have invested 200 euros. These are, so to speak, the potential losers, as they simply haven't made as many investments yet. Now let's talk about the cash flow impact. Efficient ships save between 30 and 70% in CO2 costs, receive premium charters, have higher rates, and can generally pay more dividends due to increased cash flow. Inefficient ships pay thousands extra per day. Charterers avoid them, and dividends decrease because of lower revenues. Now let's talk about the global economy. Transport costs are rising between 2 and 4%. Overcapacity is being reduced and supply chains are becoming more robust. We are seeing slight inflation in energy and raw materials. Let me be absolutely clear. I don't invest in green promises, I invest in hard facts. And the facts are clear. Starting in 2026, the most efficient fleet will win, not the largest. That's why I'm so big. I've invested in CMB Tech, Hafnia, Term, Okeanis, Dorian, and Flex LNG. Modern fleets will win the next decade, and the old ones will have to struggle. Period. If you enjoyed the video, please leave a like and don't forget to subscribe. And let me know in the comments, which shipping company do you see as the biggest winner from 2026 onwards? See you in the next hard assets video. Best of luck with your investments.